September 14th, 2007, Saturday morning. Golders Green branch of Northern Rock. Queue stretched around block. Elderly woman waited 7 hours just to withdraw her savings. 20,000 pounds. Life savings in cash. Reporter asked why she was taking money out. Her answer simple: because everyone else is. First bank run in Britain in 150 years. Cameras captured everything. Q visible on evening news. Panic spread. Northern Rock was a respectable mortgage lender. Assets worth 100 billion pounds. Suddenly nobody trusted it. Within days, government forced to step in. Taxpayer bailout. 25 billion pounds. But Northern Rock was just beginning. 1 year later, September 15th, 2008, Lehman Brothers collapsed. Fourth largest investment bank in America. Gone. Overnight. Stock markets crashed globally. Banks stopped lending to each other. Credit markets froze. Global financial systems seized up. Panic reached London within hours. Royal Bank of Scotland teetered on edge. Britain's biggest bank. Assets worth 2.4 trillion pounds, larger than the entire UK economy. If RBS collapsed, ATMs would stop working. Credit cards would fail. Businesses couldn't pay staff. Economy would implode. Government had no choice. October 2008, emergency bailout announced. RBS, 45 billion pounds. Lloyds Banking Group, 20 billion pounds. Total taxpayer exposure eventually reached 500 billion pounds, half trillion pounds, to save banks from themselves. Why did banks need saving? Because they made catastrophic mistakes. Lent money to people who couldn't repay, called them subprime mortgages, bundled these toxic loans into complex financial products, sold them worldwide. When borrowers defaulted, entire system collapsed. Banks discovered they owned worthless assets. Nobody knew which banks were safe. Trust evaporated, credit dried up completely, businesses couldn't get loans, homeowners couldn't get mortgages, unemployment soared, UK economy contracted 6%, worst recession since 1930s. Million people lost jobs, 100,000 lost homes. Government responded with austerity, cut public spending, reduced benefits, closed libraries, froze wages. Decade of pain followed, all because banks gambled with other people's money. Regulators promised never again, new rules implemented, banks forced to hold more capital, tighter lending standards, stress tests, oversight. Basel's three regulations introduced globally. Banks must maintain capital buffers, can't take excessive risks, must prove they can survive shocks. Politicians declared system fixed. We learned our lesson, they said. Banks are safer now. 18 years later, 2026, those lessons being forgotten. January 2026. Bank of England reviewing regulations, under pressure from government. Regulate for growth, ministers demanded. Treasury wants banks lending more. Economy struggling. Growth disappointing. Credit expansion seen as solution. But expanding credit means loosening safeguards. Same safeguards implemented after 2008 crisis. Financial conduct, authority considering changes, relaxing mortgage affordability tests, allowing banks to lend to riskier borrowers. Before 2008, banks approved mortgages without verifying income, gave loans to people with no deposits, assumed house prices would keep rising. Same pattern emerging now. High loan to income mortgages increasing. In 2025, 9.7% of new mortgages exceeded 4.5 times borrowers' income, up from previous quarters. Financial Policy Committee noticed trend, warned about rising risks, but also recommended allowing individual lenders to increase risky lending. Contradiction obvious. Worried about risks, still permitting higher risk. Why? Because government prioritizing growth over stability, short-term expansion over long-term safety. Basel 3.1, implementation delayed, originally scheduled for January 2026, pushed back to January 2027. Bank of England justified delay. Banks need flexibility to increase lending and investment without constraints. Translation, less capital required, more risk permitted, higher profits possible, banks celebrating, higher returns on equity achieved, investor confidence returning, share prices rising. But higher returns come from higher risk. Always have, always will. Warning signs appearing everywhere. Synthetic risk transfers increasing. Banks using complex financial instruments to shift risk off balance sheets, transferring it to hedge funds, insurers, outside investors. Sounds familiar? Should. Similar to collateralized debt obligations, CDOs, that caused 2008 crisis. Banks bundle loans together, sell portions to investors, risk supposedly transferred. capital requirements reduced. Except when crisis hits, risk returns. Investors panic, demand money back. Banks suddenly exposed again. Two high-profile bankruptcies in 2025 exposed these risks. Firms suffered significant losses. Regulators now concerned, but not concerned enough to stop practice. Just asking for better oversight and governance. Same language used before 2008. Better risk management. Improved controls. Enhanced supervision. Didn't prevent crisis then. Won't prevent crisis now. Mortgage market showing particular vulnerability. Bank of England reported 1.5 million UK households facing significantly higher mortgage costs in 2025. Fixed rate deals expiring, new rates much higher. Monthly payments jumping £300, £400, £500. Debt servicing ratio rising. Expected to reach 8% by late 2026, 8.7% by late 2027. Sounds manageable until recession hits, until unemployment rises, until house prices fall. Then 8% becomes unsustainable. Defaults begin, repossessions increase, prices fall further, spiral accelerates. Exactly what happened 2008. Government insists different this time. Household debt to income ratio actually fallen, down to 126%, lowest since 2001. But ratio fell because inflation increased incomes nominally. Real purchasing power didn't improve. People aren't actually better off. And proportion of high-risk mortgages increasing, not decreasing. Warning sign being ignored. Financial crime also surging. UK Finance reported fraud cases up 19% in 2025. £1.7 billion lost to fraudsters. Sophisticated criminals exploiting weaknesses. Technology evolving faster than defenses. Banks struggling to keep up. Cyber risks intensifying. Bank of England stress test in 2025 revealed weaknesses in systemic impact awareness and contingency planning. Translation: banks not prepared for major cyber attack. Systems vulnerable. Recovery plans inadequate. Global chief risk officers surveyed. Cyber risks identified as top concern for 2025 to 2026. Yet banks pushing for deregulation. Less oversight, more flexibility. International cooperation fragmenting too. Different countries implementing different standards. Race to bottom beginning. US delaying Basel III implementation. Europe moving slowly. UK considering going own direction. Financial crisis proved interconnected. Global system needs coordinated regulation. Weakest link determines system strength. If one jurisdiction permits excessive risk, crisis spreads globally. 2008 started an American subprime market. Destroyed British banks anyway. Hedge funds creating additional vulnerabilities. Small number control more than 90% of gilt repo borrowing. Transactions at zero or near zero collateral. Very short maturities. Requires constant refinancing. If funding suddenly unavailable, market stress, crisis panic funds must deleverage simultaneously. Mass selling, prices crash, markets freeze. Exactly what happened September 2008 when Lehman collapsed. Bank of England Financial Policy Committee acknowledged risks, published discussion paper, evaluated potential reforms, but evaluating isn't implementing, discussing isn't preventing. Papers don't stop crises. Action required, regulation needed, enforcement essential. Instead, opposite happening. Pressure mounting to reduce restrictions. Let markets regulate themselves. Free market ideology returning. Same ideology that caused 2008 disaster. Banks can manage their own risks, advocates claim. Regulation stifles growth, they argue. Trust the market, they insist. Trusted market before. Market fails spectacularly. Taxpayers paid price. Bonuses returning to pre-crisis levels. Bank executives earning millions. Taking risks with other people's money. If bets pay off, they keep profits. If bets fail, taxpayers bail them out. Privatize gains, socialize losses. Fundamental problem never solved. Moral hazard persists. Banks know government will rescue them. Too big to fail, too connected to fail, too important to fail. So they take bigger risks. Why not? Heads they win. Tails taxpayers lose. Ring fencing rules under review. Post-crisis regulations separated retail banking from investment banking. Protected depositors from trading losses. Now government considering relaxing ring fence. Banks lobbying hard. Want freedom to use retail deposits for speculative trading. Precisely what caused 2008 crisis. Retail banks gambling with depositors' money. When gambles failed, deposits at risk. History repeating, lessons forgotten. Safeguards dismantled. Political pressure driving deregulation. Government desperate for growth. Economy stagnating. Voters unhappy. Quick fix desired. Credit expansion seems easy solution. Let banks lend more. Stimulate economy. Problem solved. Except credit expansion created 2008 bubble. When bubble burst, disaster followed. Growing economy on debt doesn't create real wealth. Creates vulnerability, builds instability, guarantees future crisis. House prices already high. Average UK house costs 8 times average income. Historically unprecedented. Further mortgage lending pushes prices higher, makes homes less affordable, doesn't solve housing shortage, just inflates bubble. When bubble pops and all bubbles pop, consequences severe. Homeowners trapped in negative equity, banks stuck with bad loans, economy crashes, same cycle, same mistakes, same outcome. Some voices warning about dangers, academic economists publishing research, financial stability experts raising concerns. Professor Richard Werner, banking expert, warned deregulation often leads to financial instability and economic crises. Research confirms reducing capital requirements doesn't make banks safer. Expanding credit doesn't fix housing affordability. But warnings ignored. Growth prioritized over stability. Short-term thinking dominates. Long-term consequences dismissed. This time is different. Officials claim, classic phrase before every crisis, never different. Human nature unchanged, greed constant, fear of missing out eternal, boom-bust cycle inevitable. Only question, when will crisis hit, not if, when. Trigger could be anything. Trump's tariff wars disrupting global trade, geopolitical crisis, oil shock, pandemic, tech bubble bursting, doesn't matter what starts it. Vulnerable system amplifies shock. Small problem becomes catastrophe. 2008 started with American subprime mortgages. Relatively small market, but interconnected system spread contagion globally. Next crisis might start differently. Cryptocurrency collapse, pension fund implosion, sovereign debt crisis. Results same, unprepared banking system fails, government forced to intervene. Taxpayers pay again. September 2008. Lehman Brothers collapse Monday morning. By Friday, global financial system near death. 5 days. That's how fast stability became catastrophe. Could happen again. Probably will. System fragility increasing. Safeguards weakening. Risks rising. Bank of England holds £500 billion in emergency funds, ready to support banks during crisis. Comforting, until realizing existence of emergency fund proves crisis expected. Authorities know system vulnerable, preparing for failure, not preventing it. Fire department necessary, but better to prevent fires than fight them. Building codes exist for reason. Financial regulations serve same purpose. Weakening regulations invites disaster. Public memory fading. 18 years since Northern Rock Q. Generation of adults never experienced financial crisis. Don't remember panic. Don't understand risks. Trust banks implicitly. Older generation remembers job losses, home repossessions, pension values collapsing, years of austerity. Won't trust banks easily. Keep savings accessible. Avoid debt. Fear repetition. Politicians forget too. Current ministers weren't in power 2008. Don't carry scars. Don't feel responsibility. Easy to promise growth. Difficult to maintain stability. Growth gets votes. Stability taken for granted. Until stability disappears, then voters demand accountability. Too late then. Banking industry profits from selective amnesia, pretends 2008 ancient history, irrelevant to modern sophisticated system, but system not fundamentally different. Same incentives, same risks, same vulnerabilities, just rebranded, repackaged, relabeled, synthetic risk transfers instead of CDOs, capital efficiency instead of excessive leverage, flexible regulation instead of inadequate oversight. Language changes, reality doesn't. December 2025, Bank of England Financial Stability Report published. Acknowledged rising risks, noted increasing vulnerabilities, then concluded systems sufficiently well capitalized to continue lending in severe stress. Confidence contradicted by warnings in same report. Doublespeak perfected. Regulators warning and reassuring simultaneously. Covering all bases. Can claim they warned when crisis hits. Can claim they maintained confidence until then. Ultimate responsibility dodging. Meanwhile, ordinary people face consequences. Families choosing between heating and eating, mortgages becoming unaffordable, savings losing value to inflation, banking executives collecting bonuses, shareholders receiving dividends, system working perfectly for them until it doesn't, until crisis arrives, until bail-in rules activated. Post 2008 regulations included bail-in provisions. When banks fail, bondholders and large depositors take losses. Taxpayers protected, in theory. Practice likely different. Political pressure enormous. Voters demand action. Government capitulates. Taxpayer money flows again. Cycle continues. Profits privatize. Losses socialize. Same story, different decade. Northern Rock Q was warning. Lehman collapse was catastrophe. Bailouts were band-aid. Next crisis will be reckoning because safeguards being dismantled, lessons being forgotten, mistakes being repeated. Everyone now knows 2008 can happen again. Probably will sooner than expected. Question isn't whether banking system will fail. Question is when and whether lessons finally learned or history repeats once more.